Well, welcome everyone to this year's seminar. Okay, does the East finally meet the West? I'm Jennifer Tozser, Senior Wealth Advisor, Portfolio Manager here at National Bank Financial. And I really do appreciate everyone who came on their Saturday morning to be here instead of do all the other fun things that you do on Saturday, namely sleeping in, chores, shopping, brunching, all those other things. So I wanted to ask, is there anyone who has never been to this seminar before? Just give me a wave. Okay, thank you for coming. Thank you for coming. Now, how many people have been here, think they've been here at least 10 times? Yes. Thank you for coming back. Okay, so you know the drill. I'm going to cover a lot of the topics that I think are of interest for this year. Hopefully it will take me about 45 minutes. So please feel free, it's pretty relaxed, to ask me any questions. Don't forget to laugh at my jokes, okay? They're pretty obvious. So before we get started, I'm going to just talk about one other thing, and I did ask my client if it was okay, and I thought it was interesting because when I talk about wealth management and I talk about spending money, I always say, well, we should really make sure it lasts because nowadays people are actually retiring for generations. And what I wanted to say is my client's grandmother is 110, and she is one of the oldest people in Canada. And she was born in the teens, and she was in an internment camp in BC because she's got Japanese descent. And until last year, she lived with her daughter. She doesn't have dementia. Her daughter passed away, who was in her late 80s. So she's now in a home, but she's a bit of a celebrity. And she goes by herself. She doesn't have a walker. She walks herself to all her meals. She's engaged. She doesn't have a great short-term memory, but it really is true. And there's somebody else in this room who's also over 80 who is better golfing than me and walks the course, and you know who you are, but I won't point you out. Okay, so let's get started. So this is our agenda. I think I've hit most of the topics that we're going to cover this year, but if there's anything else that you would like me to talk about, and it's not up here, let me know, and I will cover it at the end. So let's start with Canada. Okay, so as you know, I have been bearish about Canada for the last decade, and rightfully so, but things have changed. Canada did not vote in the Liberals, they voted in Mark Carney, okay? And here are his top priorities. I'm not going to go through all of them, but as we go through this presentation, I am going to talk about the headwinds and tailwinds and how they affect the policies. So let's start with the good news. I'm going to call this the pipeline agreement. So when you are a new administration, you have a lot of political capital. And in other words, the ideas are fresh and you haven't had a chance to disappoint. So it makes sense to take items that have been difficult to get approved and for a variety of reasons and present them at the beginning of your term. So that's what happened with the pipeline agreement. This is by no means a done deal, but it's an olive branch and some recognition that Alberta's economy is a key contributor to the overall health of the economy, Canadian economy. And I would say it's definitely a step in the right direction. So now, because we're going to go quick, let's move on to manufacturing. All right. So if we talk about the next generation, there aren't a lot of people that are pursuing careers in manufacturing. And for decades, rightfully or wrongfully, the assumption has been that you only pursue a trade when you can't achieve academically. But manufacturing is not dead. Look at Ireland, okay? 10 years ago, Ireland was clawing its way out of the pig status. Now, for those of you who don't remember what the pigs were, they were OECD countries that may default on their debt. Now, is that too many acronyms? Does everybody know what OECD is? It's economically developed countries versus emerging markets. Okay, and the pigs were Portugal, Ireland, Italy, Greece, and Spain. So you can get out of your fiscal mess. So Ireland is a tiny, tiny country. And it's been able to establish and grow a manufacturing sector at a time when there is allegedly no interest. So not only do we in Canada know how to manufacture, we're much larger than Ireland. Guess how many times we're larger? Guess what our factor is, how much bigger we are than Ireland? 8 or 9 times? 10? 142. Okay, this is, oh, property, right, manufacturing. Yeah. Yeah, no, population, we're not bigger than anybody. Okay, maybe Rhode Island. So another concern of manufacturing is that robots will replace people. And that is a fair concern. But there are a few considerations. So, I mean, yes, this is right. Gone are the days where you flip cookies on a conveyor belt. But there is a lack of interest in entering manufacturing as a laborer, and there's a lack of young population who would enter because they don't have anything else to do. So this compounds the problem. So it's expected that we will see an increasing number of robots in manufacturing. I mean, you look at it right now, 470 robots per 10,000 people globally. I mean, it's not really a big number, so there is lots of room to add more robots. And where people need food, robots need energy, okay? So this is another Canadian advantage. Here we are. We are at bargain basement prices for both natural gas and electricity, which is going to give a competitive advantage to our manufacturing sector if we can get it up and running. Now, look at this map. Okay, this map, it's sort of like the game Settlers of Catan, all right? It's busy, and it's busy because we have a lot of stuff that everyone wants, so there is opportunity. This is a tailwind. So what's the problem? Here's the first one. Yeah, it's regulation. The first one, Canada has progressed from restrictive regulation to oppressive regulation, and this has led, unfortunately, right here, to our lack of business investment. Okay, but PM Carney, he's not the president of a company, he is the prime minister, and he needs consensus. So I'm not just talking about a party majority here. I'm talking about support of the general population because these are life cycle projects and will extend longer than a single administration, right? Any questions about that? Can you still hear me okay? Okay. So housing, let's move on to that. That's another priority. So there are some hurdles there, but remember, housing affordability isn't only linked to prices. It's also linked to interest rates and income. So let's start there. So good news, houses are getting more affordable, but that isn't because the price of the houses in BC have fallen. It's because interest rates have fallen. So what does that mean for interest rates in Canada? It means we need to keep rates low to continue to help with affordability. And this is where the public and economic pressure is. And by the way, when you see that gap between Canadian and US interest rates, that puts negative pressure on the Canadian dollar, but more about that later. Okay, so I put up this slide last year, and you liked it again, so here it is. So this is Vancouver. Your average house costs $1.6 million. And that's lucky, or here it is here, 118% of your pre-tax income. That's before you've paid tax. Your tax rates in Vancouver are not exactly cheap. You also have to earn $328,000 to be able to afford a mortgage payment. And if your tax rate's 53, you haven't gone shopping yet, where you pay another 12 in your combined PSTs and GSTs. So what I have been saying for a long time is that BC property is in a bubble, but that doesn't mean, and that's okay. Prices can still steadily go up when you're in a bubble. And another nature of a bubble is that they can be trends that do last a long time until a catalyst causes a change. So that's the tailwind. So let's talk about the headwind. Owning your home is one of the defining pride points of a Canadian. Would you agree with that? Yeah? Okay. But it's currently under threat. So has anyone been following what's been happening in Richmond, BC? Does anybody know what I'm talking about in Richmond, BC? Yeah, a few people. Okay, follow-up question. Until earlier this year, or I guess I should say earlier in 2025, did anybody know what the term unceded meant? Okay. All right, well, here's the short story. This map shows which treaty agreements apply to which lands, and the yellow areas are unceded, which means there was no treaty. So this summer, that's summer of 2025, the BC Supreme Court awarded ownership rights to the Cowichan tribe to over 800 acres of developed land in Richmond, BC. And these weren't the cheap seats, okay? The stretch of land was on Number 6 Road, home to blueberry farms, multi-million-dollar mansions, and an 18-hole golf course. So these are not people from Saskatchewan who had cabins on leased land, and when the lease came up, the tribes tried to jack the prices. That's not the situation. These are people who thought they bought, paid for, and owned a home. And for most people, owning their own home is a major pride point. So as you can imagine, lawsuits are now flying, and more importantly, from an economic point of view, the value of these homes is falling, businesses are being denied access to capital, and people can't get their mortgages renewed. But worst of all, other tribes are now making claims, okay? So I've talked about what can burst this BC property bubble. Look at that. I'm gonna tell you, when I found out about this, the first thing I did is I called to see if my Ontario property was treated. I could see I looked pretty good in Alberta, okay? So that's the good news. Almost no lands in Alberta are unceded. And the silver lining is there's lots in Quebec. So that should get some federal attention and hopefully some clarity on this issue, okay? So if you were an investor, how would you feel from another country? How would you feel about pouring billions of dollars into a country where this is going on? That's a headwind, okay? All right. So in summary for Canada, here we go. If Ireland can do it, Canada can do it. Okay, so here's our timeline. Number 1, PM Carney has to re-educate his party after the Trudeau years. Number 2, he needs to make changes in policy. He has to prove he can't just say it, but he can get it done despite the opposition, be it Indigenous tribes, provincial governments, or otherwise. Companies and investors need to believe that if these changes are successful, they are here to stay and not temporary. And finally, once all of this is achieved, it will take 2 years at a minimum to work its way into the economy. So, any questions so far? No? Okay, how are we doing? We're okay? I haven't scared everybody to death. They all want to call their realtor and sell their BC property. Okay, so now we're going to move on then. So we'll move on to the markets in the States. And yes, this is me, and I'm a cartoon. And yes, I did this with AI. It was a lot of fun. You know, take a picture, make me a cartoon. But I don't know if you've ever heard of the saying that markets climb the wall of worry. So here it is, and I am going to address these items that are on people's minds. So let's start with tariffs. We're all familiar with the America First policy, but why tariffs? This is why. As you can see, over the last 35 years, the US has been increasingly relying on foreign goods, which means that the US dollars are leaving the country to the benefit of the trade partner. And you can see that China has benefited the most, all right? And Canada, a very important trade partner, has been relatively stable. Now, this slide shows that the US has been successful in collecting tariffs. So the US was collecting about $8 billion a month before the change. So it wasn't zero tariffs to tariffs. There were always tariffs in some situations. And that was the old regime. And then April came and started, and now they are stabilizing at $32 billion per month. That's about 4 times as much tax. That's a lot of money. And other countries are now, and Canada included, are now looking to see how they can also benefit from more protectionist policies. Okay? Well, how does this work? So as we sell goods to the US, if it's affected by a tariff, it's actually the US citizen who pays more. That's right. So how come this hasn't affected demand? Well, let's look at the Nike example. So If the full impact of the tariffs on Nike's shoes went to the consumer, last year's $100 shoes would be about $156. Guess how much the price increase was roughly on those shoes? It wasn't $56. Just give me a guess. All of you guys who bought shoes for your kids. These are US dollars. It's actually only between $5 and $10. Okay? So why? How could that be? Next slide. So this is where Nike is manufacturing. If Dustin, give me the next part, please. These are the tariffs that are applied to each country. So what Nike's been doing has been moving its manufacturing from higher tariff countries to lower tariff countries. And Nike is taking smaller profit margins, and Nike is asking its supply chain to take smaller profit margins. So that's how it's being managed for now. I don't know that that's going to be a long-term solution, but that's what's currently happening. So are tariffs here to stay? I'm going to tell you it's going to be hard to get rid of them. And one of the reasons why is that they benefit very, very specific groups, and those groups are willing to spend a lot of money to defend their position. Okay? Any questions about that?
Which groups?
These groups. Steel, transportation, aluminum, trucking, all that kind of stuff. Whatever's on this picture. But you'll see it. So it's all of the things where they want to manufacture it in the States, right? They don't want to manufacture $5 t-shirts. They do want to manufacture steel. Okay?
Jennifer,
Yes.
what's going to happen if the U.S. Supreme Court overturns the tariffs?
I love this line. I love this question, okay? So here's the thing. One of the things, I mean, I'm not here to support Trump, okay? Please don't think that I am. But he's done a couple of things where he's created bipartisan agreement. So I think what the Supreme Court could say, I look at the potential outcomes, shouldn't have done it, should have done it, or some kind of qualifier. They're not dumb. They know that they could bankrupt their own government if they said these are illegal, we have to repay them. So they're not stupid. So I don't think that's very likely. I think what's possible is they could say, well, we don't like how the tariff rates were imposed. What we think we should do is they should have been approved by Congress in this manner, and then throws it back to Congress, who now all puts their hand up and says, yeah, we like the tax revenue. That's what I think is going to happen. It's not the tariffs that were legal, it was the process. So as long as the process is approved, then they were all valid. That's what I think. I don't know, nobody called me. But at the same time, it's a great question, but I have given it some thought. And that's one of the reasons I'm not too worried about what the Supreme Court says, is because you can't get money. You can't get money, they're not going to give the money back. Because the Supreme Court's going to say, or the president's going to say, well, we spent all the money on Americans, so can we get the money back? You can't. It's gone. And they want that bill, they want the 30, what do I say, however many billion, 32 billion of revenue. They want that. Any other questions on that? It was a good question. Yes?
What's the difference in our situation now with these tariffs that's different from before free trade agreement was put in historically? So
Okay, so that...
same boat as them, or how are things different?
Oh, that's such a tough question. Thank you for asking it. I talked a little bit about it last year, and when I talked about it, and I don't have an answer across every industry, okay? But before free trade, one of the things that I distinctly remember is that American companies had to have Canadian head offices if they wanted some tax advantages. And when free trades went in, all of the head offices immediately went back to the US. And if you weren't identified to go move back to the US, there was an issue. Another situation where it wasn't a free trade agreement, but it was a trade agreement that was really successful in the past, was the auto worker agreement, right? What made a car Canadian, what made a car American, how many components, how many had to be built where. That was great. With what's happening now, which is we're just going to charge, they're not agreements, they're like they were before. Right now, they're just very reactionary. 20%, 30%, 10%, right? It's not, it's different. So the method that the tariffs are being applied is different. It's not, and even though it's different, remember for years, we still don't, I don't believe we've ever had a softwood lumber agreement, never got reinstated. Once it expired, we were without an agreement for a long time. So there's just lots of problems. But what makes most uncertainty is when things are changing. Okay, because companies can't decide where they want to invest and how they want to go forward when things are changing. And that, the speed with which these tariffs changed is what caused the uncertainty, right? Because if you've got all these tariffs and you invest in this life cycle project that's going to take you 30 years and then 3 months later the tariffs are gone, well, maybe your profitability has changed. So I don't know how helpful that was. Yes? Yeah.
What do you think will happen, because Trump's been saying he might not renegotiate the CUSMA agreement,
Which one is this one?
the one that replaced NAFTA?
Oh yeah, he might not renegotiate it?
Yeah.
That's, okay, so I'm going to talk about that. So one of the things, and I'm not going to talk about that agreement specifically, I'm going to talk about how Trump negotiates. So this is how he negotiates. He escalates, and then he negotiates. He escalates, and then he negotiates. That's the escalation. We'll wait for the negotiation. That's just his technique. Okay, good question. Okay, no more hard questions for now. Where was I at? Okay. Okay, so now we're going to go on to our next super fun topic, which is the U.S. debt. Isn't that lovely? This is has everybody seen these slides before? It's online, it's dynamic, it flashes, they have different things. They have different things that are happening. It's the scariest slide that I put out. So right now the U.S. debt, yep, that's 38 trillion. Okay, I personally can't even fathom that number. But let's talk about the slide. First thing, yeah, right there. The U.S. debt is going up. And I'm going to point out that that debt number can't go down if there is a deficit. So the deficit has to change to a surplus first, and that's the second item I want to show, is the deficit right now in the U.S. is decreasing, according to these guys who are generally pretty good. And I would tell you, I would suggest that's a direct relationship to the new revenue from the tariffs, right?
But the deficit is 4.6% of the debt, so that's how much it's increasing.
The deficit is decreasing.
But it's that number is 4.6% of U.S. national debt.
Yes.
So it's increasing by almost 5% per annum.
Okay, but at least it's decreasing as a deficit. Most countries don't have decreasing deficits, they have increasing deficits. Okay? So this is a whole issue that's across all of the OECD countries.
Does that include the $500 billion he just added to the?
Well, this is live. This is live. So when we printed this off, it was in December. So it changes. Like if I wanted to put it up live, so you could see it moving, but we don't have the technology for that. But you can look it up at any time. So, by the way, I know that this slide is confusing. So imagine being, Jay Powell at the US Fed and trying to implement policy. But before I get to that, let's talk about some financial concepts. All right. So the first is inflation. Now, I'm assuming that everyone knows what inflation is, but basically it's when your chocolate bar used to cost 25 cents and now it costs $1. So there is an opposite term in economics, and that is deflation. Now, deflation is harder to identify, and it's harder because we don't mind when the cost of our items decrease. So when I was in my early 20s, you gave a lot of thought to whether you bought a computer, or you used your cell phone, or you made a long-distance call. Nobody gives that any thought anymore. That's because the prices have depreciated, okay? And they've depreciated or they've deflated, so they cost less in real terms. That's what deflation is. So what people do care about is when their assets decrease, but their costs, their assets deflate. So there are two main ways that can happen. I was getting ahead of myself there. The first way is that the value of the asset actually goes down. And the second way was what happens is that the price appreciation of the asset does not keep up with or outpace inflation. Okay, so that's a harder one to see, but you know that if your grandmother gave you $1,000 and put it in a teapot and presented it to you 20 years later, you would have wished she'd invested it, because what it was worth 20 years ago is not what it's worth today. That's what we're talking about. So just quick check, everybody understands this difference? Yeah? Nobody's gonna go home and tell anybody deflation's when you let the air out of the balloon? Okay, so inflation is intuitive, deflation is beneficial for services, but not for assets. So what happens when you put them together? What do you get? This one, stagflation. So stagflation is when inflation applies to your goods and deflation to your assets. This is an economic and political nightmare, and is something that may result from US government policies, specifically the tariffs. Now, it's obvious that no one wants their costs to go up while assets go down, but why is it so hard to manage? It's because you have to choose which evil to address. If you lower rates, you increase inflation, and if you increase rates, you affect the value of the assets. And this is why all eyes are paying attention to the US Fed and their interest rate policies. In both Canada and the US, the Bank of Canada and the US Fed have to determine where the biggest risks are for their economies. Okay? So, FX is next. Many things can affect FX rates. I'm going to focus very, very narrowly on the Canadian and US dollar rate. So if Canada does a good job executing their policies, it should reflect in our currencies. Now, I don't have to put up a slide to tell you that the US dollar is much higher today than the Canadian dollar, but I did, and there is room for improvement. As the market gains confidence that we are changing our economic performance trends, this trend should also start to change. All right, so speaking of numbers, oh, you got ahead of me there, Gus. He's like, get on to the next slide, Jen. Okay, so let's look at the US market. So 2025 was a great year. But there's been a lot of concern that only a few stocks are creating the return. So I wanted to talk about the performance concentrations. So how do you read this slide? All right, so NVIDIA is at the top. NVIDIA is the biggest stock right now in the S&P 500. Okay, it's 4.5 trillion. It represents 7.8%. And last year is up 34 and almost 35%. Okay, so it was a big year. So these are the top 7. That top 7 group represents 37% of the S&P 500. And of the total return of 16.65, this group was 9.68% of the 16.65. Okay? So 7 stocks was just over half of the actual return. Could you give me my weighted so I can explain that, please? All right, I didn't give you this on your slides because it'll just give you a headache. But another way to look at it is to say, if NVIDIA was returning 7.8%, so 7% of the index returning 35, of that 16.65, it's 2.73. So if you did not own NVIDIA, your return was 13.9, okay, not 16.65. That's how that works. I wanted to point out in these magnificent 7, if the average return was 16.65, 1, 2, 3, 4 of 7 did not beat the average of the market. So everybody's talking about how these are the big contributors. The biggest contributor also wasn't NVIDIA. It was Google last year, or Alphabet. Okay? So there we go. So what we have to accept is that, okay, where am I at here? Oh yeah, here we go. Okay, can we look at any questions about this before I move on? Okay, so let's look at valuations. You can see that the Mag 7, they're trading right now. Here they are at about 29 times forward price earnings ratios. That's expensive, for sure, but in 2020, they were trading at closer to 40 times. So this forward PE ratio has actually been falling. So how can that be when the prices of the stocks have been rising? It's because earnings have also risen. So there are two big ways that a stock price appreciates, all right? One is what we call multiple expansion, so your price earnings ratio goes from 2 to 4. And the other way is you have earnings growth. So usually they both work together. Okay, so which means is that as your company starts to earn more money, you start to get multiple expansion. But in this case, here we have companies earning great money and we have multiple contraction. So that just speaks to the strength of those underlying companies, that their prices have managed to go up with that kind of a economic headwind. So the other item that I would like you to look at on this slide is that we get corrections all of the time. And the corrections are the little blue and lines and the pink lines. So since we have been at National Bank over the last 7 years, we've had 4 corrections and 2 bear markets. Okay? So they happen all the time. So there are always things to worry about in the market. And despite that, we've still made good money. So going forward, remember, you have to expect that there is going to be some type of a correction roughly once per calendar year, and a bear market roughly once every 18 months. Okay, so back to valuations. Here's the thing. When we hear headlines, we hear $800 billion of sell-off. Well, as humans, we have the same reaction as we do when we hear about government debt levels. But what does it mean? So if you look at this slide, NVIDIA's big sell-off was a big loser at $350 billion, but that was only 8% of return. And after that adjustment, the stock still finished the year up 35%. So we have to accept that big growth stocks are going to have big volatility, and they're going to make big news headlines. Yeah? Questions? No? Okay. So going forward, what else should we look at? I love this slide because this talks about the CapEx. These companies are going to be able to continue to dominate as long as they continue to invest heavily in R&D. And don't forget, currently, right now, there's a major global race going on. Okay. Sidebar here. These investment numbers, the amount of money that these guys are investing is more than some entire countries. And it's only 5 companies. Okay. Any questions about that? No? Okay. So what about the bull market? So is it getting long in the tooth, right? Well, the answer is no, not really, because we had bear markets in 2000 and 2022. So, and if you look at this long bull market here, I always say I never really felt like it ran from 2009 to 2020. I always think this is recovery from, till 2013, because that was the big crash here in 2009. But the other thing about this market that I think is interesting is it didn't become a bear market because of price market valuations or economic performance. It changed to a bear market because of COVID, right? So that's just a completely different reason that some things have ended. Global markets. So here are global markets. Are they cheaper? Yes, actually, I agree. They are cheaper. And I want to look at this slide. So Europe is cheaper than either the US or Canada on a forward PE number. But with the exception of Europe, how much cheaper has been consistent? So in other words, Canada was 24% cheaper, now it's 26% cheaper, but Europe, on the other hand, was 28% cheaper, and now it's 37% cheaper. So why did this discount widen? Because poor policy and poor execution caused an increase in the discounts. So here's the good news. Europe is finally loosening their financial conditions. Their industrial production is picking up, and their inflation is stabilizing. So, are we going to invest there? Yes. We've already been investing there. We invest there through mutual funds, ETFs, and if I can find decent direct stocks, we'll buy those as well. And we have been adding exposure through 2025, and we will continue to do that. So what about China? Okay, they're a big player for sure, but we can't ignore them, but they have their own set of issues. So the Chinese government has been stimulating their economy through loans. And if you look at this slide, despite the fact that they have double the population of the US and 3 times the debt of the US, they have approximately only 2/3 of the GDP. All right? So I want to show you this next slide. to show you what this means. This is debt as a percentage of GDP. So even though the debt number for the US is increasing, as we saw on the previous slides, the ratio is decreasing, which loosely means that the borrowed money is creating productivity. Now, noticeably, there are 2 countries that have elevated debt levels and poor trends, and those are France and New France. Canada. Right? Okay. But as per my previous comments, I do hope that for Canada this is going to change. I know that the PM has made this a policy goal. Any questions on this stuff? Yes.
Can you just state your conclusion again? Canada's gonna.
Well, yes, this the whole trend of increasing debt as a percentage of GDP, but the other trend, but remember, it didn't go into investment. Remember the big investment gap and all of those things? Those are big changes that the PM is trying to make. All right, so should we go on to the fun stuff now? You ready for a break from all this economic stuff? Okay, here's our fun stuff. So crypto, stablecoin, gold, and AI. All right, so crypto. All right, here we are. Yes, you would have made money if you bought crypto at its origin in 2008, but it's been a wild ride. At any time, and you can see this on the slide, it can drop 60%, just like that. So let's talk about some catalysts for crypto performance. So the first one here, it's 2020, was actually COVID. How could COVID be a catalyst? It was because young people were sitting at home, bored, and dabbling in day trading. Don't tell me if you did it. Okay, but everybody went back to work, and shockingly, Bitcoin tanks. What do you think the second catalyst was? Give me a guess. Here it is here, beginning of 2024. Pardon me? Did I hear it? Yes, that's exactly what it was. Trump loves crypto. Crypto goes up. When his administration it changes, maybe all the other nonsense, maybe this will change as well, and it'll go back to reality. You have to remember, there is nothing behind crypto. It's supply and demand only. Now, I invested money in the tech markets of the late 90s, and crypto has the same patterns of behavior as that market. It's gone up for a long period of time, but I think that there's finally a competing item to dethrone crypto, and that is stablecoin. Okay, has everybody heard of stablecoin? Okay, so what's stablecoin? Stablecoin, it's a digital currency that is backed to an asset such as the US dollar or gold. So it has similar features to Bitcoin. It's got anonymity, lack of government oversight, ease of transfer, low costs, but it has one large difference, and that is that there is a reference asset, and that makes it much more important. Now, if you're a normal Canadian, which by this definition means you're not a drug dealer or somebody who's trying to evade their taxes, stablecoin doesn't hold a lot of appeal for you. But what if you're living in Argentina and you get paid in dollars, and then because of inflation and everything else that's going on there, they're in stable currency, a week later, that's worth pennies. Or what if you live in a country that has currency controls like China, where you're only allowed to have so much money that can leave the system? All of a sudden, this has a lot of appeal for you, okay? So let's take a look at some current stablecoins. All right, so these are the current top 10, or current, yes, by market cap, and every single one of these is tied to the US dollar. Now, when I look at this, I would have assumed in some fashion that you are now holding US dollars, right? But look at this part here. These are the reserves, all right? They aren't the same. A question real quick, does everybody know what a fiat reserve means? Anybody want me to explain it? Yeah, okay. So what a fiat reserve means, it means that there is not a hard asset that's behind the currency. It's based upon the economic strength and reputation of that government. Okay, so that's why we always talk about our economic performance. And when I say a reputation, you don't have a lot of fraud that happens in Canada and the US, where you have a lot of fraud in Bolivia. Okay, so that's what a fiat currency is. So here you've got, cryptos and shockingly fiat currencies. So now here's the position of these guys. I love this line. It's put it at the bottom of this here. Stablecoin, I'm going to read this. Stablecoin uses derivative markets for stability rather than fiat reserves. Okay? I'm going to say that one again. Stablecoin uses derivative markets for stability rather than fiat reserves. So unpack that for a minute. Show of hands. What do you think is more conservative, owning US dollars or owning stock options and futures on cryptocurrencies? Do you even have to put your hand up? Do you see a problem here? Okay, I mean, this is in its infancy. But back to stablecoin. Are there risks right now? Absolutely. 1, lack of oversight. Number 2, business profitability. Number 3, accountability and trust. We are trusting that when stablecoin says that you can exchange your tokens into US dollars, it's really true. But right today, we really have no way to know. So having said all of that, with the exception of price speculation, there is no reason to own Bitcoin when there is the stablecoin option. And this could cause a tsunami of crypto sellers, which will lead to the collapse of all the tokens. Okay? Yeah? No? We'll see. Any questions? All right. Can I be wrong? Of course. Of course. Maybe Bitcoin will all of a sudden say, now I'm backed by the US dollar. Who knows? But I think there's a lot of risk there. So let's move on to gold. So how does this fit in? Well, if you accept that Bitcoin and stablecoin are anti-establishment types of investments, in other words, ways to separate your wealth from the government, then gold is also an option. So we have buyers of gold for stablecoin. We have buyers of gold from central governments, and we have my favorite buyers of gold, of course, the ones for jewelry, so use. So where do I think that the gold prices are going to go? Well, gold, the prices, the trees don't go to the sky, which means I don't expect huge increases in the price of gold, but there is opportunity in gold stocks because like other commodity stocks, they've been working hard without price appreciation in the stock market for a long time. And whatever I say for gold applies to silver as well, right? Applies to all precious metals. So there's room to catch up. And let's move on and wind this section up with AI. So I'm going to start with a question here. If you could guess what was the worst financial crisis we've had in North America in the last 100 years, what would you guess? I'm going to make you guess. Who said that? That's right. It's the Great Depression. All right? All right. And during that time period, the time period of the Great Depression, when things were the absolute worst, which market developed and was making tons and tons of money? It was an emerging market at that time. It's just being developed in North America. What was it?
Oil.
Who said that? That's right. It was Texas oil. I was shocked because I was reading a book and I couldn't believe they had the numbers of the money that people were making in the 30s because everybody was getting their oil from the Northeast up until that point. Then Texas came in. And I was looking at the numbers and I said, oh my God, they had no clue. They had no clue, all right? So it was a staggering amount of money. So how come this takes me to talk about AI? It's because AI is emerging, all right? It's emerging. So quick show of hands. Who has integrated AI into their daily use? ChatGPT, yeah, thank you. Okay, next question. Who's seen AI integrated in their work? Thank you. Okay. Who thinks that the usage of AI will increase over the next few decades? You're all right. I'm going to go out on a limb and say everybody's right on this one. Okay. So let's talk about it. Simplified, here are the stages of AI. They're the enablers, the monetizers, and the adopters. So I think we can agree that once you adopt AI, it is a tool that you continue to leverage. So are there bubbles? Where are the bubbles? This is one. Investing and processing units, equipment, including data centers. Now, I'm going to compare this to the fiber optic cable run in the late 1990s. Fiber optics was the core infrastructure for the dot-com boom. Okay? So the amount of fiber laid at that time could actually circle the Earth Guess how many times it could circle the Earth? Yeah, that's how much fiber optic cable, how many times could the fiber optic cable that was laid in the late 90s go around the circumference of the Earth? 40, 100. Who said 1,000? Yeah, you're close. 650 times. 650 times. And in the US alone, at the end of the rush of 2001, there was enough excess capacity to handle between 20 to 30 times the demand. So it was a race, right? If you got there first, you won. If you got there last, you lost. So Bitcoin, I want to talk about this as a potential bubble. I talked about the performance of Bitcoin on its own, but look at its tremendous outperformance compared to the S&P 500. Okay, that makes no sense. Canadian housing. Well, actually, just as an aside on Canadian housing, I always show Vancouver. I could have shown Toronto, but I also have Calgary here. Calgary's not in a housing bubble. Does anybody want me to go through the Calgary slide, or do you want to just pick it up at the end if you want one? You want to hear the Canadian? Okay. So so I've talked about the housing bubble in Canada. Calgary is different. So if you could remember, it was, what was it, 1.6 million or whatever for a house in Vancouver. Can you go back to that slide, please, Dustin? Okay. All right, so here, 1.6 million or 1.7 million in Vancouver, 735,000 in Calgary. 118% of your income to buy a house in Vancouver, 43.9% in Calgary. What was another thing we talked about on here? How many months do you need to save that? 447 compared to 54. Okay, so you can check out this slide. If you want one of these, you can get one of these, or if we run out, we can send them to you. Calgary housing market's not the same as Vancouver or Toronto. You can save money, you can buy a house, and we're about 15% cheaper compared to, for what you buy in Calgary is 15% cheaper than the rest of the country. So I always tell people to look at their insurance to understand what I'm talking about here. If they tell you that you could buy that it costs you $1 million to rebuild your house, but you buy it for $850,000, that's 15% cheaper. Okay? Here, when they're telling you that it's, what is the premium here? 39, oh, that's for renting. 90%, what they're telling you in Vancouver is you're paying $1.9 million for a house that costs $1 million to rebuild. Okay? So that's the premium discount thing. Make sense? Okay. So yes, you can, don't worry about your Calgary house. Next thing I think that's, give him a minute to go back here, but the next thing that I think that's in a bit of a bubble right now is government bonds. So when you have an unbalanced budget, it can either be because of lack of revenues or overspending. So on this backdrop, how come I am so constructive for 2026? I actually am. I think it could be a good year. And I want to talk about what the US has absorbed, or what we have absorbed over the last few years. We've absorbed pandemic shocks, rapid rate hikes, geopolitical volatility. So looking forward, we have expansionary fiscal policy. So the BBB bill that they have down in the States should start to show its effects in Q2. Trade policy uncertainty is going down. We talked about that, how we react. We're used to how Trump negotiates now. We're used to the escalation and then the negotiation. So the markets have adjusted to this technique and are just shocked. AI is going to contribute, its contribution to GDP is not easily measured, but it's expected to be at least 1%, which is a significant number for the first half of 2026 alone. So these are all good things. So let's talk about the final stretch of our seminar here. So this is our annual, we take our stock portfolio once a year, we run it through a screening program, and we get a letter, and we got the letter A. So it was good. That's the 5th year we've done that. Good to talk about performance. We finished off 2025 with about 11% return. I was really pretty happy with that. I thought on the back of 24% roughly the year before that we might be looking at more of a horizontal market. But having said that we had 11, I am going to talk about people, I know, or you should ask me, well, why not 33? Okay? And that was what the TSX did. And the reason not 33% for the TSX is because, I think, is because of gold, all right? I've got to come back and talk about gold. Gold was what made the TSX get its big number this year. And gold is tricky. And I'm not going to go ahead and put a third of your account in gold. It's not a good idea. And here's why. Gold doesn't always do what it's supposed to do. So here's something that gold is supposed to do. Gold is supposed to go up when there's problems with fiat currencies. So in 2008, when there was the big, great financial crisis, and everybody was worried that banks were going to go bankrupt, gold should have gone up, gold tanked. Okay, it didn't go up. You might remember me speaking about this at a previous seminar. I always call them my vanity stocks, or things that aren't doing what they're supposed to be doing, and gold was one of them. I bought it because I expected the price of gold to go up with inflation, and I had to sell it 2 years later at a 5% loss because it didn't go up. As a matter of fact, it continued to fall to about 35% after I had sold it at a small loss. And now it's on its big, huge run. When you look at this slide, another thing I want to point out about this slide is that these are inflation-adjusted numbers. So when you're looking at how high the price of gold is today, of course it should be higher than it was in 1980, but not when it's adjusted for inflation. So this is a very, very elevated price of gold. And if it falls, it can fall really fast. Do I own gold? Yes. Should we own gold? Yes. Am I aware of this? Yes. Am I glad that we didn't put 30% of your portfolio into gold last year? Well, the numbers would have been fun, but that's risky. And that's just almost, that is gambling, and I'm not going to do that, okay? Any questions? No? Okay. All right, so let's go to the next slide here. This is our auto-callable notes. I always go through this slide every year. And I will go through the examples. So this was an example of an actual auto-callable note that we had bought. And it was based on the S&P 500 index. So if you had invested $100,000 and 1 year later, the S&P 500 index was at the same level, which was 1,400. So if it was 1,400 or greater, you got your 8.25% return. If it was lower, you went into your second year, and if it hit the 1,400, you got 16.5. If it took 3 years, you got 24.75. So that's all great. You make money. But what if the S&P 500 never recovered? What if it didn't go back to 1,400? This has a 20% barrier of protection. So if the S&P 500 fell by 19.9%, you got your money back, but you didn't get your interest rates. You didn't get your 8, 16, or 24. You just got your principal. And if the market was negative 22, that's what you get. You get negative 22. Okay? Now, this is a performance of what we had happen. And in 2025, we had 17 notes that got called. That's not surprising. 2025 was a strong year, so everything got called. We only had 2 notes that were rolling into their 4th year. And Laura, correct me if I'm wrong, but I'm pretty sure we had one of those call in January, didn't we? Yeah, so we already had one of those calls, so I expect the other one to be called too as well. And since 2013, we've had a total of 167 of these notes that have been called with an average return of 14.19. You know this, you have them. So then there's their sister investment, which I'll talk about. Those are the income notes. Okay, so these ones, instead of paying once a year, pay every month with the same idea. So if the market in this case is higher than negative 30, it pays, and if it goes up to above 5%, then it gets called. So we had 23 notes that were called in 2025, and we currently have 20 that are open. And the average rate that we got in 2025 was 8.91%, and we received 100% of our payments. We track this every month, we look. So we got all of our payments, nobody missed. So it was good. All right, moving on. This is just our economic summary. The big thing here is that we're going to buy more international. Unless you've asked me to specifically, I'm concerned about fixed income. I think interest rates could go up. I don't think they'll go up as much as they did in 2022, but I think it's an issue. And I just want to bring up gold again. When I tell you the gold price will be between 4,500 and 5,400, that's really a pretty big range. So what I'm saying is I expect volatility. Okay? Next slide, please. These are the places that we get our research from. Some are very expensive, some are very inexpensive. They're just to help us make our decisions. Finally, a note from our, oh, this is my team. I didn't even say thank you to my team who does so much work with us throughout the year. Who's here? Laura's, okay, let's see. Laura's here, Ramon's here, David's here, Dustin's here, and Ralph's here. Everybody, they're there at the back. Plus Patrice is here from head office. Thank you, Patrice. All right, these guys do a lot of the work. All our lawyers said hello, can't forget them. And I think that's it. Thank you. Yay.